Yeah, thanks everyone so much for joining on a Saturday morning to discuss market linked debentures. Clearly, we have a very happening live to be discussing an intricate debt product on a joyful Saturday. Let's hope it's worth. So just a brief introduction about Samastiti Advisors, who we are. So we are financial planners. We help you plan your financial life. We provide investment advisory and wealth management services in a very comprehensive manner. We are advisors and not distributors. We don't sell financial products. So there are agenda and no commissions. So we truly are able to provide unbiased financial advice. We are licensed as a SEBI registered investment advisor, which provides you with complete transparency and peace of mind. And we really believe planning is a process and it's not a one-time activity. So if any of you post this webinar would like to explore our services, do write to us. Do spread the word of our young organization. And on that note, let's take a look at what the session flow will be for today. Set the context of why we are even discussing what we are discussing, and there's a bit of history which is important to understand before we can appreciate what a market link debenture really is, and also appreciate and understand what are the kind of changes that were introduced in the previous budget with respect to this instrument. We'll take a look at the 2002 CBDT circular, which is very important to understand what happened to market link debentures recently. We'll take a look at what MLDs are, what the rationale is, why does this product even exist. We'll look at the changes announced in Finance Bill 2023, have a look at its impact. If you hold MLDs, what should you do? We'll provide our advice. And of MLDs or looking for a short-term opportunity to buy MLDs, what are the things to be careful about? And we'll end, with the Q&A. So in terms of the context, it's very important to understand, how the capital gains, and interest income taxation works, in our tax laws. So if you take a look at an equity product, and if you look at the capital gains, they are very favorably taxed. % for short-term capital gains on equity, 10% for long-term. In the case of capital gains for debt products, the short-term capital gains is slab rate, and for long-term, it's 20% indexation. So when it comes to capital gains for debt products, it's slightly inferior to the treatment for capital gains in equity products. But I would still say it's a lot better compared to how interest income is taxed in a debt product, and that's completely at a slab rate. This is important to understand because this is really the crux of the issue at hand, because one of the key problems of investing in a debt product like a bond or a fixed deposit is that you get interest income, and they are very punitively taxed. I mean, it's straight away taxed at your marginal tax rate. And assuming that most of us here are in a 30% tax bracket, it's straight away 30% of that is taken away, as compared to say investing in an equity product, like a share on equity mutual fund, where you get capital gains or losses. When you invest in an equity product, the predominant way through which you are trying to make money is through capital gains, and they are taxed very lightly. Now, which is why for quite some time, and I would say many years, there has always been a bit of an approach that how can you structure a bond where you get capital gains and not interest income. So prior to 2002, this was done through a zero coupon bond. So if you take a look at this slide, and if you take a look at the normal bond, how the taxation works. So if you have a 100 rupee bond, and after year one, say it gives an interest payout of 10, so you're taxed at 30% on that interest. So you pay 3 rupees as tax, and say the bond matures at year 2, again paying 10%, 10 rupees interest. So that's again 3 rupees of tax. So you have paid a total tax of 6 rupees on this transaction. Now, if you look at a zero coupon bond, it works very differently. A zero coupon bond is a bond which does not have intermediate interest payouts. Everything comes at the end, both the principal as well as the accumulated interest. Now, if you invest 100 in a zero coupon bond, and this was prior to 2002, this is how it used to work. The zero coupon bond will accumulate an interest of 10 rupees in year one, but because it's just an accrual interest, there is no tax to be paid. In fact, you have not received that 10 rupees, so there is no tax that needs to be paid on that. And even on the accrual basis, there was no tax. And very close to the maturity, say very close to year two, if you sell that bond for say 118, so you have made a capital gain of 18 rupees and you pay 10% tax on that, so that's 1.8 rupees. So essentially, a bond prior to 2002 allowed you to convert interest income to capital gains, and which was much more favorably taxed, right? So compared to 6 rupees of tax which you paid in a normal bond, out here the tax liability has been significantly cut down to only 1.8 rupees. So a zero coupon bond was this magical product that allowed you to convert interest income to capital gains, but that changed with to CBDT circular. I've provided the details of the exact circular on the footnote. What this circular did was it specified that even though you receive interest in a zero coupon bond at maturity, you will still need to accrue interest each year and offer such accrued interest for taxation. So a very, very fascinating circular, because what this circular does is it takes away a big tax for investing in zero coupon bonds. You have to accrue the interest each year available for taxation. Second, and this is really the difficult part of the circular, where it specified that when you sell a zero coupon bond, the capital gains are calculated not from the issue price, but from the last annual fair price. And this circular also put a requirement that every zero coupon bond has to be evaluated annually. It has to be valued annually, because that's how you are going to offer tax on that instrument. So there has to be an independent valuation of that bond, and you'll have to pay accrual tax. And the capital gains is calculated not from your purchase price, but from the last valuation. Essentially, this was a way for the circular to tell the taxpayers that when you sell a zero coupon bond, it doesn't matter how long you held it, it's going to be taxed as short-term capital gains. So two things, if you look at, in fact, I have a slide here. After 2002, which is after the CBDT circular, the taxation between a normal bond and a zero coupon bond came to pretty much being the same. So if you take a look at a zero coupon bond after 2002, at the end of year one, when it accumulates an interest of 10 rupees, you have to value that bond and you'll have to pay 3 rupees as tax. So it's the same as having invested in a normal bond. And when you sell that bond for say 108, and you have earned a capital gains of 8 rupees, you'll have to pay a tax on that, because it will be classified as short-term capital gains and not as long-term capital gains. Even though you're actually selling after 1 year, it'll still not be classified as long-term. It will be classified as short-term capital gain, and you'll end up paying 30% tax on that, right? So it's essentially the same taxation as it was for a. So after 2002, the tax arbitrage in zero coupon bonds, but it remained for MLDs. And let's take a look at this. Now, before we go into how the taxation worked and how it will now work for market linked debentures, just a brief slide on what market linked debentures are. So they are essentially bonds that do not have a fixed payoff. See, one of the defining characteristic of a bond is that it has a fixed repayment date and it has a fixed repayment. In the case of a fixed interest bond, the coupon is specified. And even if it's a floating rate bond, it's linked to an external benchmark. So the payoff, is not linked to an unpredictable market event in the case of a normal bond. But in case of a market-linked debentures, the payoff can be completely based on any diverse event that you may want to link. You can even issue a market-linked debenture that if there is an earthquake, an interest coupon will be paid. If there is no earthquake, no interest coupon will be paid. Anything, is entirely a bilateral instrument, so the seller and the buyer can arrive at whatever payoff matrix they, are comfortable with. So an MLD could have a payoff as at maturity, the investor will receive no coupon if, say, Nifty falls by 50%. Otherwise, the investor will receive a 10% coupon. So why were these kind of bonds issued? So there are some specific use cases, for these, weird, bonds. One being that, say, if there's a business enterprise whose earnings are linked to how the equity market does. Now, if it issues a traditional bond, its interest outgo is fixed. But if it would want its interest outgo to vary based on how the equity markets have done, this was the only instrument which was available to them, right? So if, say, the Nifty falls by 50% and the earnings of that business enterprise takes a hit, they will not have to pay a coupon on their market-linked debenture borrowing. They'll only have to, give back the principal. In fact, most market-linked debentures, are principal protected. So the principal is protected, the coupon, is variable. So this is, what a market-linked debenture, is. Now, if you look at a market-linked debenture, it had, features which made it completely bypass the CBDT circular issued in 2002. First, if you recall, that circular specified that in a zero coupon bond, or in a deep discount bond, you will need to accrue interest income and pay tax. Now you can't accrue interest in a market linked debenture year on year because you simply don't know what the payoff is going to be. The market were protected, from the tax man coming and telling you that this could be an instrument which has a rear-ended payment, but please accrue interest or earnings every year and offer it for taxation. You couldn't do that in an MLD simply because it was impossible to predict what of course, the taxman can always ask you to value that bond, or that MLD based on current scenario and pay tax, but that was not the case. It would be quite an outrageous demand, for the tax department to make. So MLDs were protected from interest accrual, like how it was applicable on zero coupon bonds. Second, the circular, the way it defined a zero coupon bond, did not fit that definition because a zero coupon bond still has a fixed payout, even if it's rear-ended. In the case of MLDs, it was completely variable. So, the CBDT circular was not applicable on MLDs, and MLDs for that reason could function like how a zero coupon bond used to function earlier, right? So after 2002, the tax arbitrage on zero coupon bonds were completely removed, but it was still available, for MLDs. You could invest 100 in an MLD, you could sell it close to maturity, and if it's a listed MLD, you just pay 10%, long-term capital gain tax after 1 year. So the tax liability is significantly lower. So this was really the rationale for market-linked debenture. It used to work for the issuers who could have specific usage for structuring the payoffs in the way they had structured it, and it used to work for the investors, who were given much better taxation compared to traditional bond. Now Finance Bill 2023 has changed that. Rather than going into the nitty-gritties, what you simply need to keep in mind is that it's just specified that the full value of consideration received as a result of transfer or redemption or maturity of MLDs, it shall be deemed to be capital gains arising from the transfer of a short-term capital. The funny thing in Finance Bill 2023, and if you compare it with the CBDT circular of 2002, is that the CBDT circular of 2002 was trying to achieve a lot of things in a very, very complicated manner, the effect was the same. Zero coupon bonds will be taxed as short-term capital gains. You can do whatever you want, but the circular stopped short of saying that. It just, if you follow the provisions of the 2002 circular, the end result is will be taxed as short-term capital gains. I think in Finance Bill 2023, they have not tried, to dilly-dally or beat around the bush. Straight away, blanket specified that in case of an MLD, it doesn't matter whether it's capital gains, it doesn't matter whether it's long term, short term, it doesn't matter whether the proceeds you have got it not out of sale but out of redemption on maturity. Right? Nothing matters. We are going to tax this product as a short term capital asset. So essentially, before, for listed MLDs, the holding period of more than 1 year, the long-term capital gain tax was 10%. For maturity proceeds, it was slab rate. Now, for any gain, either capital gains or selling, during maturity, it will be taxed at the slab rate. So it depends on what slab rate the investor pays in tax. The end result is that gains from MLDs will always be taxed as short-term capital gains. Now, what is the impact? If you take a look at a typical MLD investor, MLDs were generally available in a lot size of 10 lakhs. So many retail investors who had taken exposure to one MLD or two MLD invested a small amount, say 10 lakhs. Say the return was 10%, 10-year. Earlier, the majority proceeds 11.54 lakhs, and there was a capital gain projection of 1.54 lakhs on this transaction. Essentially, earlier they would have paid a 10% capital gain tax, so the return would have been 9%. So for a 10% MLD, you pay 10% capital gain tax, and the return is 9%. Now the tax is 30%, so the return comes down to 7%. I think for a typical MLD investor who's in a 30% tax bracket, this is not earth shattering. Of course, any additional tax outgo always hurts. But at the end of the day, we are talking about instead of 9% post tax return, earning a 7% post tax return on an amount of 10 lakhs. Is not, I wouldn't say that is a particularly problematic issue for a retail MLD investor whose exposure to this instrument is very, very small. But for the super rich MLD investors and MLD investors, a lot of high net worth individuals have invested significant amount of money in MLDs. And for the super rich investors, they could be in the 42.7% tax bracket. That's the super rich, tax bracket. And there, of course, both in absolute terms as well as in terms of post-tax return, it's a significant, a hit, because from 9% it's coming down all the way up to 5.7%. In fact, it could be lower than that, depending on what price they're able to sell the MLD. So the return, in this, and I think this is the investor community which has been hit hard by the change in taxation. In fact, there was an expectation that when tax changes do happen for MLDs, it would probably be prospective. But in this case, all MLDs, which are any MLD transaction after 1st April 2023, the new regime will kick in. So in effect, it becomes applicable even on earlier MLDs, and there are representations being made that can this be we are yet to see whether those representations will be accepted by the finance ministry. Now, the change in the tax applicable for MLDs is from the next financial year. So if you can sell your MLDs before 31st March, then you don't have to pay a higher tax. However, what we are seeing is that the quotes that investors are receiving for selling their MLDs is those are not attractive quotes at all. In any case, our bond market is very, very illiquid. Even for example, a AAA or a AA, that's where there is some liquidity, but below that, there is hardly any liquidity. most MLDs could have a credit rating of below AA or starting AA. So the secondary market for MLDs is quite poor, which means that if you try to sell your MLDs, you may not get a good quote. And in fact, we have been encouraging investors to draw up scenarios and see whether it actually makes sense to hold till maturity and pay full tax rather than trying to sell, because that could be a worse off scenario, right? So if you small illustration that we have built, if somebody tries to sell their MLD proceeds, say they invested in an MLD at 10 lakhs and they're trying to sell it at, say, 11 lakh 15,000. Ideally they would have sold it as, say, 11 lakh 53,000, but let's say they're not getting a good quote and they're only able to sell at 11 lakh 15,000, right? So the return is actually poorer than what they would have got if they would have simply hold till maturity and pay the full tax. So I think there's a big frenzy that, okay, let's offload the MLDs that I hold, let's offload the MLDs. And what many people are actually not understanding is that the incremental tax liability, better to pay that rather than to exit at a very, very bad price. We are also seeing instances where investors are trying to engineer MLD sale themselves. For example, a husband may try to sell the MLD to his wife. Similarly, a wife may wanting to sell the MLD husband, or they could identify friends, where where they can sell, or relatives. We recommend not to do that. This is because there commercial basis for a transaction, and a transaction which is carried out purely to avoid paying taxes, it can attract provisions of GAR, which are the avoidance rules. These set of rules came into practice a few years back, and it's a law. It's an Indian law to prevent. It's an international law as well. Indian law as well, to prevent aggressive tax planning and to prevent tax evasion and tax leak. So if you are selling an MLD to a counterparty who's not really a third party, and who doesn't and is not properly arm's length from you, and it's purely being done so that you can take benefit of the earlier lower capital gain taxes, it could raise issues at the time of filing. Now, GAR provisions, they come into the picture when the amount involved is large. However, for a very, very small transaction, possibility that it can pass below the radar of the income tax department. However, it could still come up, and we would recommend you not to do it. And we would recommend that you, in unless you have a very good quote on your hand, you should just hold it till maturity and pay the tax. Because there are a lot of who are trying to sell MLDs. So a lot of wealth managers are trying to arrange a sale among other clients by trying to show them that you can perhaps buy an MLD and earn a very, very strong short-term gain. So it will provide an exit to somebody before March. They'll get the benefit of the favorable taxation. And for the person who's buying it, the IRR and the return can be made very, very attractive. However, this is being done without consideration that the budget has also introduced a TDS on interest income of 10%. So if you are if you are looking to buy an MLD to earn some short-term gains, you have to take that TDS into consideration while negotiating the selling price. So let's take an example. If there was an MLD which was issued in April 2021 at, say, 10 lakhs. In April 2022, let's assume the MLD has a coupon of, or the expected of 10%. So it accrues a value of 11 lakhs, and April 23rd it accrues a value of 12 lakh 10,000. So that's the maturity value, expected maturity. Now, without TDS, say the seller wants to, now because this MLD is maturing in April 2003, the new tax regime will come into place. So let's say the holder of this MLD is looking to make a quick exit, and he or she is willing to do this at a discount as well, right? So in March 2020, do a transaction to sell this at a discount at say 11,95,000, right? So they still make an 8.8% return, which is then what the return would be when the new tax regime will come into place. The buyer pays 11,95,000, and at maturity, the expected payoff is say 12,10,000. So they make a cool return of 16%. However, this example does not factor in TDS. Post budget 2020 TDS in place. So when the buyer of the MLD receives the majority proceeds, there's going to be a TDS, and post that TDS, what they'll actually receive will be lesser than what they actually paid for the MLD. Of course, this TDS is the tax deducted at source for the interest income earned by the MLD during its full tenure, whereas the buyer has only been holding that MLD for say 1 month. So there is a possibility of a refund. However, that's only the only way a buyer can get a refund on this is actually to incorporate this TDS into the selling price itself. Where when they're actually buying the MLD from somebody else, the seller has to, in the buying price, incorporate an element of TDS, and then the transaction has to happen. So it can be quite complicated. It's preferably, if you're looking to buy an MLD, you should work with an advisor or a CA and do a proper computation and not get caught in this TDS trap. So there, suppose the MLDs, there's a people are very curious to see where they can look for yield product. And if you look at the issuances of MLDs, it really happened a lot when interest rates were quite low, and inflation was still high, so the real interest rate for most investors were turning to be negative, and MLDs provided a good opportunity for them to earn a higher return. I think for investors who have subscribed to MLDs, even post the higher taxation, the post tax much better, and will provide an inflation hedge. Now going forward, the MLD market will come down, with an important rationale for investing in these products will but this also comes at a time when interest rates are increasing. RBI has there was an expectation that in February probably the interest rate increase would be paused, but hiked interest rates, the commentary is still hawkish because there are inflation risks. So the interest rate outlook, is quite good for savers, and you can see how the rates have gone up in fixed deposits, ultra short-term debt funds, or in plain vanilla bonds. All of these products have seen a big jump in their interest returns. So I think for investors, going forward, the outlook for investing in debt products will be very good. Even if you remove alternative products like MLDs, just for traditional products itself, the yield is starting to look a lot better. So key takeaways, for long quest on how to convert interest income to capital gains, it was zero coupon bonds where it used to be done, and until recently it was MLDs. But the CBDT circular of 2002 and the finance bill has closed these avenues. If you have invested in MLDs, we would suggest that you hold them till maturity. And if someone is showing you an opportunity in MLD from a short-term gain perspective, we would suggest you closely look at the TDS impact before finalizing a deal. Interest rates are increasing in the economy, so it's bettering the outlook for returns from plain vanilla debt products. So it's not such a bad situation to be in. And if you invest funds under the growth option, you can still convert interest income to capital gains. So I think I would like to end with this positive thought on a Saturday morning that debt mutual funds, which are as plain vanilla an instrument as possible, still gives you this incredible opportunity to take benefit of long-term capital gain tax with indexation. And actually, that's a vehicle which actually converts interest income to capital gains, for you. So yeah, so that's about MLDs. We would love to hear from you. You can drop us an email at support@samasthiti.in. You can visit our website, follow our YouTube, Substack, channels for frequent updates. And we hope to keep connecting with you over multiple such webinars. If you have ideas about what we should speak about, please to let us know. We'd be keen to hear from you, and of course do also let us know the feedback for this webinar. So I'll do is I'm happy to take in questions. So what you can do is, okay, I do see, okay, some questions. So let me take that one by one. So there's one question which says a name of some MLD schemes will help, as we keep hearing this term again and again. So there are multiple. It's mostly issued by non-banking financial companies. So for a non-banking financial company, money is literally the raw material. They are in the lending business. So they keep tapping the capital markets for raising funding. And many of these NBFCs, issue, market-linked debentures. Prominent ones, would be rated AA, but there are many smaller names as well, where ratings could go to A, triple B. So multiple such issuances, are there. In fact, there are fund vehicles also, which, like for example, AIF, which primarily and only invest in MLD. So there could be an AIF scheme which only invest in market-linked debentures. Similarly, this is a product which is available, in a PMS platform as well. Okay, so what's the tax treatment for hybrid funds? So for hybrid funds, if it's a conservative hybrid fund, it's taxed as a debt investment, product. In fact, the treatment, the taxation of mutual funds, whether it's equity mutual fund, debt mutual funds, or a hybrid, nothing has changed in this budget. And if you look at an aggressive hybrid fund, where where the share of equity is more than 65%, you get the benefit of equity taxation. So there's a question on GSEC strips. They offer the option of converting interest income to capital gains. So this 2002 CBDT circular, which we talked about, is actually also applicable on strips. In fact, that circular is applicable on deep discount bonds, and deep discount bonds is a generic term for any bond, which has a zero coupon bond kind of a structure, which is issued at a discount and then matures at par value, right? So it's applicable on those, and it's also applicable on instruments where you're stripping interest. So I don't think that arbitrage is available, in the case of strips as well. So this is a interesting question. So what are some of the NBFCs that raise money through MLDs, and what will be the impact on their debt raising activities? Does this source completely dry up for them after this? So one of the concerns of this tax change on MLDs is that it will affect the refinancing capabilities of NBFCs, or at least those NBFCs which were relying on market-linked debentures as the main source of borrowing. I would say, that if at all there are NBFCs which were entirely or substantially relying on MLDs, these would be very, very few. If you look at the MLD issuances of the overall corporate bond market, or if you look at the share of MLD issuances as a proportion of the NBFC, borrowings in general, it's a very, very small share. In most cases, it's less than 5%. In some cases, it touches 10%. It's not for well-capitalized NBFCs, for NBFCs which have a diversified sources of borrowing. It doesn't really create a refinancing risk. In fact, some NBFCs, which had issued MLDs, and in conversation with their, investment bankers, are buying back those MLDs before March 31st. So that's a signal that their balance sheet is strong enough to provide an exit to investors before March 31st so that they can take benefit of favorable tax. So I don't think it creates a problem for most NBFCs. Of course, this is generic. There could always be a few NBFCs where this could create refinancing risk. So there's a question on MLD linked with only index, or it can be. So yeah, with respect to the earlier question on what are some of the NBFCs that raise money, it's across the board. The larger ones, for example, IIFL, Edelweiss, Shriram, Transport Finance. So you have very big NBFCs which have raised them, as well as very small. I think it was quite a universalized product, and I think most NBFCs would have experimented with some form of MLD borrowing. There's a question on MLD linked with only index, or it can be gold specific stocks. So actually, we have seen MLDs linked with diverse, indexes, diverse instruments. So it's really, really, as creative as you can be. I would say that it doesn't have to be linked. It could be linked to a specific stock. It can be linked to a government bond. In fact, there are MLDs which specify that, say, if the 10-year government bond yield goes up to 15%, which is a rare scenario. Hopefully, if the share goes up, if the yield goes up to 15%, then no coupon will be paid. Otherwise, the coupon will be paid. So there are MLDs issued, MLDs issued by government or private player. It's essentially an NBFC market. So it's essentially a private NBFC market. There's a question on if TDS can be taken into the buyer's account, then it is to the benefit of the buyer, right? Yes. So when you are, negotiating a sale, you need to factor into that sale a TDS component for how much of a period of time the existing seller was holding that instrument. That needs to be factored into the selling price, and then the transaction is fine. So if you're getting a really good deal on an MLD sale, so let's say an HNI is really trying to exit their MLDs, and you're getting a good offer, and that incorporates the TDS impact, you should go ahead, keeping in mind, of course, that you're okay with the credit risk. Okay, and we have a very nice suggestion for a subsequent webinar, which is on the changes in EPF and whether you should opt for the new pension scheme. So thanks for that suggestion. We'll definitely keep that in mind. Okay, so I think we have run down. If anybody has anything to share, you can send us raise a hand, and I'll be happy to unmute you. Any further questions? Happy to take them. Yes, so cumulative NCDs, we have a question on cumulative NCDs. Yes, it gets taxed as interest. So it doesn't matter what the instrument is. See, the 2002 CBDT circular, the reason why the tax department is very smart is it never, specifies the exact product on which that circular is applicable, but it defines the product features in general. So a cumulative NCD is actually nothing but an example of a deep discount bond, where, the interest, keeps accumulating and towards the ends. You can call it by whatever name, but at the end of the day, it's an example of an instrument where interest is accumulating, is not being paid out on a quarterly and a yearly basis, but is being paid out at the end of 2 years, 3 years, 5 years, whatever. It will still attract the provisions of that circular, and it will not allow you to take benefit of a tax arbitrage. Yes, so there's a question on TDS on all NCDs, whether Form 15G is available. I'm not aware of whether such a provision is there where, like, for example, in a fixed deposit, you can submit a form and ask the bank not to deduct TDS on interest income. Not in the taxable bracket. I'm not sure if that is there, but I have noted the name of the participant who raised that question, and we'll get back to you on that. So unlisted MLDs, again, there is no tax arbitrage on unlisted MLDs. In fact, for unlisted MLDs, the capital gains, is much more prohibitive than 10%. It used to be 10%, without indexation, 20% without indexation. So there is no risk. There is no respite even if you take into account an unlisted MLD. Okay, great. So I think I'll now leave all of you to enjoy your Saturday, and thanks a lot for joining. And if there are any questions in your mind which we did not cover or that we're not able to take, please do drop us a line, and we'll be happy to get back to you. Thanks so much for joining. Have a great weekend.